My name is Tim Craighead. I'm the Chief Global Content Officer for Bloomberg Intelligence, and it's absolutely my pleasure to have everyone with us today on what I think is bound to be an awfully interesting discussion over the course of the next 45, 50 minutes. Let me share my screen for a little bit to get things started. I have the pleasure of co-hosting this webinar today with Avinco. And what we'll be looking to cover in our mid-year outlook and thinking about positioning into the second half is a couple of things. First thing, there will be some housekeeping I'll get to in just a moment. Second, importantly, in terms of the details of what we're looking to discuss, think about tariffs and US policy and what the implications are. From a broad perspective in general, whether it be equities, whether it be fixed income, whether it be currencies, what about the concept of American exceptionalism? Is it alive or faltering? And then we can get into some details about equities and fixed income and think about alternatives. Be interesting to discuss thematics as well. As always, with our Avinco webinars, this being the 26th of these Trend Watch webinars, there's the opportunity for questions. If you have them, please pop them into the chat, and we'll try to feed them in over the course of our discussion or at the end. Give you a little bit of backdrop. Avinco runs a series of fund forums bringing together asset allocators with fund companies. They're across Europe. There's already been, I guess, 8 or 10 so far this year. There's a host coming up in the second half, as you can see here, the ones coming up, whether it be in Spain or Switzerland, an interesting one up in the north of Scotland, and then elsewhere. There's also Avinco Analytics, and I'll touch on a couple of points of reference that they bring to bear, which I think is awfully interesting. And it's a pleasure for us at Bloomberg Intelligence to work with Avinco on these webinars. One brief comment about Bloomberg Intelligence. We are the investment research business within the Bloomberg. If you've got the terminal, you've got us, almost 500 investment professionals covering asset classes around the globe, markets, industries, companies. Please feel free to ping us, IB us. We'd love to engage. That's what we're here for. Let's get on with the discussion at hand. First topic that we want to get into, that I'd like to discuss and get perspective on, is policy. And I forgot to do one thing right up front. Apologies. I need to introduce our panelists. My goodness, that's the important part, most important part today. I have the pleasure of being here with 4 highly experienced investment professionals. Yannis Stennis is the CIO of asset allocation at OP. Daniel Morris is the chief market strategist at BNP Paribas Asset Management. Patrick Armstrong is the CIO of Plurimi Asset Management. And Andrew Jackson is the head of investments and fixed income boutique at Vontobel. So interesting experience, interesting exposure. We've got asset classes covered here from equities through fixed income. And between the 5 of us, we've been through a couple of market cycles, and it seems like we're headed into an awfully interesting period in the second half of this year, given what we've already experienced in the first half. So let's dig in. Okay. Policy, trade war, tariffs. Let's think about where we're at this point. I've shown you here a chart coming from our Bloomberg economics team, looking at the estimated effective US tariff rate. And no doubt we've been through a bit of a pause over the course of the last couple of months. The question is, where do we go from here, coming up with the August 1st point and into September, where we're likely to see that effective tariff rate tick up again. From there, it's not just tariffs. We've got a tax cut that's highly likely to be coming through from a U.S. perspective, with some follow-on legislation. And there's a whole bevy of other deregulation or regulation innovation elements that are set to happen in the second half and on into next year. So with that in mind, I'd like to raise the discussion with the group. What about tariffs and trade war? Let's start looking ahead by briefly looking back. What's been your approach to dealing with all of the volatility, looking at the beginning of the year, and then how are you thinking about policy from the U.S. As you look into the second half? Patrick, shall we start with you? You're on the top of my screen, so you get the first nod.
So we came into the year, our base case for the U.S. economy was a no landing scenario where we expected the U.S. economy to grow at 2.5% and not suffer the soft landing or the recession other people were worried about. But when the tariffs did come in April, we do think that it's changed our view. We think the U.S. economy is going to continue to grow, but at less than 2.5%. We think more like 1.25% is where we're going to get growth. So we do think the tariffs have hurt growth. They've definitely hurt confidence in terms of consumers and business. And we were overweight equities at the beginning of the year. We added to equities in early April, and I didn't think the rebound that we've seen would happen. I thought it would be a slow grind where Trump would do 180s, but not to the quick extent he did maybe. And we're still overweight equities today based on the view that Trump's rhetoric is going to be much harsher than actual policy. So there's a risk that I'm being complacent here, but our view is the August 1st 35% tariffs, 30% tariffs aren't going to be put in place. And if they are, they're very short-lived. It's going to hurt growth, but not completely remove growth. And we've got an environment where we've got tax cuts, monetary stimulus coming, subdued growth. That's probably sets the stage for equities to grind higher from here.
No, cool. Andrew, shift from that point of view to the thought about fixed income, or more broadly, if you'd like, in terms of where Vontobel's thinking.
Yeah, I think we headed into the year with a healthy dollop of caution and skepticism about markets. Our conviction was not that the US would do X or Y, but rather that the year would be full of volatility. And our guidance to our clients and our guidance internally within the fixed income team was we're at elevated valuations almost everywhere at the start of the year. We're at elevated valuations, and you should be cautious because of that. But you should be nimble, you should remain liquid, and you should be active. Now, reflecting on that, that was a great call. Post-Liberation Day, that gave our clients really, really great guidance and allowed them to trade. But I think that even we were surprised with the move and the degree of volatility that we saw. The VIX hit the second highest level since the financial crisis, and it hit it pretty flipping rapidly. Credit spreads widened by 50% in the blink of an eye, and it was almost impossible to trade anything. And yet here we are just a few weeks later with little having changed, and we're back at those incredibly stretched valuations that we were at the start of the year. So as much as I agree broadly with the comments, I think US economy is probably in better shape than the bearish part of me wants to point to. I think there is an irrational level of complacency within markets. And every time something massively unexpected occurs, 2 weeks later, we've dismissed it.
It is interesting. There is no doubt. Yanni, Daniel, how about you two?
Yeah, I can comment a bit on how we have been managing the situation. We also went to the year with a slightly positive risk-on view. Took it down gradually when we saw dark clouds forming above the US. But we never actually went sort of de-risking totally the portfolio. We went to a sort of neutral position during the spring, which we then gradually started taking on more positive risk tilts in the portfolio. So that's sort of the most bearish we were was sort of a neutral view. And sort of echoing on the previous comments, I mean, markets nowadays tend to rebound really quickly. So these don't tend to last long. It seems to just be shorter and shorter as time passes. Every one of us remember years ago when we have crisis, they used to last a little bit longer. And a good example of that was the Iran, Israel, US sort of geopolitical tensions, which basically the market totally ignored. But of course, tariffs have been with us, and markets have gotten used to it by now. And it seems sort of that there's maybe a little bit too much complacency also in my view, but we're still tilting the portfolios towards slightly overweight in equities, and also the fixed income positioning for slightly risk on mode.
Nope, fair enough. And Daniel?
Well, maybe to pick up an angle that hasn't already been covered. I mean, at a high level, we're cautiously optimistic, overweight equities, overweight NASDAQ in the U.S. I think in terms of managing this, though, I mean, on one hand, everyone expected to have volatility with Trump, so we've had that in spades. Of course, the point then is to take advantage of that volatility, and we've had plenty of chances to do that. I guess if we think about the framework, so a couple people have already mentioned, even if you're worried about tariffs and what might happen on August 1st, expectation is, well, it actually won't happen to the degree that Trump is threatened, or even if it does, not for very long. But I think it's important to think about why you think that's the case, because really there's two narratives in this with different outcomes. So if you think it's a taco story, and in other words, that Trump will chicken out and won't go through, or he goes through with it and the markets fall and then he backs off, that's all well and good. You end up at the same place. That is, you actually don't get the tariffs implemented sustainably. Or alternatively, you see this as just yet another example of Trump's negotiating tactics. If for whatever reason he's annoyed or upset by something, he threatens tariffs. And then hopefully gets the response that he's looking for, and then reverses that proposal because something's changed. Now, again, you end up in the same place, but the difference is if there's a response, say, particularly from the EU, to the threat from Trump, meaning, and as I think we've seen so far, they haven't reacted aggressively. They're really trying to get along with Trump and offer a solution. So I think you then end up with something ideally in August where the Europeans have offered more than they probably thought they were going to, or certainly probably more than they would like to. And that's different than if it's just a taco reversal where Trump backs off and there's no change. Because in the alternative scenario, where to achieve something from a negotiating point of view, you're arguably in a better position for the U.S. So I think we not only want to think about the outcome that you anticipate, but also why you think you get there.
Interesting. Thanks all four of you all for giving a little bit of historical context as well as some thoughts in terms of where you're leaning from here. I think from our perspective, our equity strategy team, it is of the mindset that the bar has come down a lot from where it was at the beginning of the year. If you look at earnings growth expectations for this year, they cycle up pretty rapidly into next year, which does raise a question because inevitably with the tariff issue as it's been, even if it was to have stuck or will stick, it's too early to really see those impacts. We have those are yet to come. So, we tend to be more, Gina Martin Adams tends to be more of the idea that, she agrees on the stretched point of view and that disappointments now are a lot more risk than they were 2 or 3 months ago. Let's shift gears and get into certain thoughts on asset classes. Bring up the topic of U.S. exceptionalism. Now, you think about it earlier this year, DeepSeek hit. The EU defense imperative hit, spurred possibly by Trump, but it still is a big spend that Germany has ignited from the standpoint of defense and infrastructure spending. And then we had tariffs. And we clearly saw underperformance of U.S. equity markets for a while, but they've started to come back. You look at this long-term trend of U.S. exceptionalism in U.S. equities, it's pretty interesting. What about asset flows from here? And these are some of those Evenco analytic data points that I had referenced early on. It's pretty interesting stuff. If you look at the left-hand panel here, these are the projections in the month ahead from the standpoint of fund flow by asset class that Avinco tracks. And it's broadly towards equity, no doubt. But importantly, on the right-hand side, to see the time series of where this data has flowed, money markets were big early in the year. Those have backed off to more normal levels. Equities were low at the beginning of the year and have cycled up quite markedly. And if you start digging into some of the regional elements, this is all funds, equity, fixed income, etc. And you can see that US allocations have shifted lower, even though they're still significant, where Europe, whether it's UK or broadly, have been cycling up a little bit. And breaking that into equities, you definitely see a building in Europe, sort of static in the US. And lastly, from a fixed income perspective, you can see that European asset flows in the world of fixed income versus US have been really interesting, very large and rising. So I think some interesting data points from the standpoint of what we're seeing when it comes to the concept of asset flows, maybe the breaking of US exceptionalism or not plays into this, or other factors. Let's look first at equities. You all, in various ways, commented on this a little bit in your opening comments, but where do you see the best opportunities? Europe, Japan, emerging markets, still the U.S. What are you thinking about at this point? Yanni, do you want to jump in?
Yeah, I've gotten the question recently a lot. Should you sort of start to ignore U.S. equities, and should you start, underweighting them, not only tactically but also strategically? And my answer to that has been, so it depends on your starting position. And if we look at portfolios in Europe, multi-asset portfolios, depending on the source, the equity allocation to US is been between 35 and 45%. And to me, that's quite a low number, actually, if you compare to MSCI ACWI or indices like this. It's substantially higher. North of 60% is the US allocation. So if your starting point is really low, I think you should be thinking about, do you really want to go further down in your allocation? When you think about where the most qualitative companies in the world are, the US companies have an advantage. They have a better regulatory environment. The earnings has been strong for many years. Out of the last 40 quarters, they beat expectations, 37 out of them. So that's quite a strong performance, even considering that they lower estimates than at least before the earnings season. The end result is still quite compelling. So I think US companies will still do well, and you shouldn't strategically.
I think we've gotten Yanni freezing. Hopefully he'll unfreeze here in just a second.
Far from these global.
Can you hear me? Yeah, now we can hear you. Okay.
Great. So just to round it up. Yeah, sorry. Just to round it up, I think you still should be looking at US companies because they are of high quality. And just to comment on the European sort of outlook, we've seen the flows, and there's a lot of flows to Europe, and we're actually overweighting slightly Europe tactically. But I think for Europe, there's a lot of eagerness ahead of the fiscal stimulus coming, but that needs to trickle through to actual earnings for the companies, and we don't see that happening yet. We are talking to companies, listening what they have to say. They are waiting for earnings to pick up, but we haven't seen that yet. So there will be a time for Europe to actually show the numbers. But we're a bit optimistic, and where we have highest conviction is actually emerging markets, where earnings are really strong and valuations are still low.
Interesting. Daniel, thoughts from your perspective on this?
Sure. We appreciate the enthusiasm that you've had for Europe over the last couple months, which we share, but also I think tempering a bit, as Johnny mentioned. I think that, in terms of what we've seen from the flows, I think at a minimum, it's relative to what you thought was going to be the case at the beginning of the year when most everyone was, very overweight U.S. equities. Without question, Liberation Day was a shock. And you concluded, well, gosh, the outlook for U.S. isn't quite as good as I thought it was going to be. It's probably better elsewhere. Again, you mentioned DeepSeek, so China and EM looks better. So absolutely rational to reallocate your portfolios versus what you had. And I think that explains a lot of the fund flows that you showed. After you've done that, however, if you're looking at a 5-year horizon, do you really think now that European equities are going to outperform the US? And I wouldn't imagine we'd find too many people who are going to be willing to make that case. I mean, we all know about industrials, we all know about infrastructure spending and defense, but there's a lot of other stocks in the market, and we appreciate the constraints that Europe faces. So we see it as a reallocation, a very rational one, but fundamentally do think US exceptionalism from that point of view, i.e. sustained outperformance of earnings and therefore sustained outperformance of the market, we think that's still in place.
Oh, cool. Patrick?
So we're underweight the US. I've got 52% of my global equity strategy in the US. My benchmark for the MSCI developed world is 72% US. So I've got a lot of US equities. US equities are expensive, and if American exceptionalism does exist, I think that's where you want to allocate to the US stocks, the ones that are exceptional. So we've got a lot invested in the US. I own Nvidia, I own Google, I own Meta, we own Apple. These are companies that are exceptional. They're trading at premium multiples, some of them. Meta and Google are trading at market multiples right now. Allocating to exceptional companies, paying a premium multiple makes sense, but the index as a whole is very expensive. Even when you strip out the Mag 7, the index is worth a lot more. If a company's in Europe and it makes $1 of earnings, it trades at $15 market cap. If it makes $1 of earnings in the US, you're at 23 times market cap. So every month we've been moving a little bit more underweight Europe and playing themes like European defense. That's structural growth, in my opinion. These are very expensive companies on a trailing earnings basis. They're not expensive on a forward-looking basis, in my opinion. Infrastructure stocks, cement companies that are trading at less than 10 times earnings. Germany's finally putting in place fiscal thrust. The US is tapped out in fiscal thrust. And part of American exceptionalism is just smoke and mirrors. If Germany ran the same deficit the US did every year since COVID, German growth would have matched US growth. It's just they've been very prudent, too prudent, and now they've got the dry powder to create that fiscal thrust. And the US it's got a terrible decisions to make with the amount of debt they have. They either need to increase taxes, they're cutting taxes, go for austerity, they're not doing any efficiency things. So what you're left with is you need incredible growth to grow your way into your debt. And the White House say they're going to grow at 4.5% next year. And that's nonsense. They won't. So it's going to be printing money, new money to pay off the old debt, tapped out in terms of fiscal thrust. So I do think Europe is finally getting the fiscal expenditure that's going to lead to a re-rating of European equities, not to US levels, but a convergence.
Oh, fair enough. Very interesting. And I'm happy, Andrew, to have your perspective from Vontobel on this, but if you also want to shift gears and think about the fixed income side of things, given your day-to-day job, either angle on that would be welcome.
Yeah, happy to do that. I have to pick up on the point made about, maybe the US has got some problems coming down the line. I think it's really important for us to acknowledge that the world is shifting in a way that maybe it hasn't shifted throughout the whole of my lifetime. I think geopolitics does matter. I think fiscal rectitude does matter. I think debt sustainability does matter. What Patrick's talking about matters, but it might take a very, very long time for the markets to realize that it matters. That's the challenge, I think, that we have to always remind ourselves that over the long term, this debt does need to be repaid, but the market can ignore that for a reasonable period of time. I also wanted to pick up the fact that when you look at graphs of what's happened to the US and Europe, and you start in January of this year, you're starting from a starting point where Europe has delivered spectacular underperformance for a very long period of time. So it looks like Europe is doing really well versus the US, but actually a lot of that is just playing catch up. So I think there is some structural bias. And then I also wanted to pick up on the flows within fixed income. And there is a technical below the surface there, which is the gap between what you get from credit in Europe versus underlying rates, and what you get from credit in the US versus underlying rates. The fact that rates are in decline and heading negative in Switzerland, which is where my home base is, but heading towards zero again in Europe, but far from zero in the US, the relative amount that you get paid for credit risk within a fixed income portfolio is much lower in the US than it is in Europe. The result is that when people look at investing within the universe of fixed income, they're still able to allocate significant amounts of their fixed income allocation into money markets and cash-like instruments in the US and generate a reasonable level of yield, but they're being forced to stretch themselves a bit more in Europe into more traditional fixed income assets. So yeah, I think what the point that Patrick's making is absolutely critical for us to enforce. It might be ignored for a long period of time, but for me, I want to remind everybody that maybe the US won't be the global economy in 10 years' time for the first time. The US used to be the global economy. For the whole of our careers, it has been the global economy. 10 years from now, it probably won't be. It might not even in 10 years' time be the largest economy in the world.
Very interesting. Thank you. We'll come back to fixed income broadly because I'd like to get everybody's perspective on this. But while we're still talking about the American exceptionalism concept a little bit, another element that plays off of this is the dollar. And you all have seen this and know this sort of a trend from the standpoint of the dollar index versus the 10-year yield. They tend to trade together for obvious reasons. And there's clearly been a disconnect over the course of the last several months. There are a lot of reasons behind this. If you want to take the most extreme, it goes back to the U.S. exceptionalism point of view. Is the U.S., because of policy uncertainty and other elements that flow largely from the White House, is this changing? Is this dynamic changing? What's your thought about currency and the dollar as a reserve currency and the stability? Any thoughts on that front?
Happy to go first on that one, if you like.
Yeah, go for it.
I think we are being asked, and the US yield curve is asking us to imagine a scenario in which the US may not repay all of its debt. And that's a pretty staggering statement. But close your eyes for 1 second and imagine a situation where Donald Trump is in the White House. A large proportion of the external debt is held by China, and he is faced with the choice of haircutting some of that debt. Could he do that? I think it's absolutely possible that he could. Now, I think I would assign a very low probability to that, but I think that's what the markets are telling us, that they are contemplating that. And I think that's a really, really fascinating, scary, but fascinating question. And the difference between a 0.01% probability and a 0% probability is infinite. And that has an infinite impact on markets. If once we start to think about this reserve currency, once we start to think about this US dollar debt dominance and the assumption that the risk-free rate is that reserve currency, I think it has implications for every investor around the world. And we do probably need to contemplate that. Hopefully I've retired before we get to that question.
Anybody else want to jump in on this?
I don't think I keep it at 0% chance the US defaults explicitly on its treasuries. But I think they can effectively default, and I actually think that's exactly what they'll do, that the US doesn't have to default, doesn't have to give haircuts on its treasuries. 94% of all the treasuries outstanding are conventional treasuries. 6% are inflation-protected treasuries. So you just do a massive printing of money, you effectively default on your conventional treasuries. The inflation-protected ones you don't care about because they're so small, but that's how you destroy. You just repay China with funny money. You give every US citizen $1 million tomorrow. All of a sudden, all the debt in the US is canceled for citizens. They've got tons of wealth. They love Trump, and China suffers because their $1 trillion of treasuries is now worth $500 billion or whatever it works out to be. So when Moody's downgraded the US, I don't think it was about an explicit default, but it's about an implicit default where basically monetization and the end, unfortunately, of every empire historically is a debasement strategy where the empire tries to continue to be great and grow and debasing the currency. In Roman times, it was actually adding lead to gold coins. In modern times, it'll be just printing more money than you have economic growth.
Oh, fair enough.
Good on you for being brave enough to say that, by the way, Patrick.
Brave or silly, we'll see.
There's
Just
a
to
question.
continue a bit, I mean, we saw some trends, diversifying trends when it comes to reserve currencies. So the US share was in a slight decline already before this current administration started with the current program. Will it, however, derail its status as the number one reserve currency? I think we're still quite far from that. But it makes sense to diversify a bit, so we'll probably see that trend happening. And when it comes to US dollar outlook, we are a bit cautious when it comes to the dollar, actually, and you know, it's been a really quick ride lower. So we are thinking we'll see some stabilization, and we see that happening now, but probably it will continue to weaken, you know, midterm. And when you're building portfolios, investing, you still want to allocate to those quality companies we talked about, but maybe deploy currency hedges just so you're hedged against dollar weakness.
Oh, fair enough. And I would say that our currency strategist has, I think, a pretty fascinating report out on de-dollarization as a longer term trend, and you know, has a longer, modestly bearish call on the dollar, not overtly thinking things are going, you know, to hell in a handbasket, so to speak, but that there are more pressures than there is any sort of emerging structural bull case or cyclical bull case.
One thing just to say that Trump's obsession with the US current account deficits, he ignores the consequence of the massive current account deficits, which is a massive investment surplus. It's just mathematical. That's the way it works. When you run a current account deficit, you've got the investment surplus. So that leads to flows into the S&P 500, into treasuries. And that's the unintended consequence of the obsession of current account deficits. As you neutralize that, you diminish the inflows into the US dollar and US assets as well.
Yes. I mean, which is part of our de-dollarization story for sure. There was a question that came in that ties on some of the things we've talked about here. Over the next 3 years, which of the following could deliver the best inflation-adjusted returns? Floating rates, tips, fixed income, long duration, or equities? Any takers on that question?
Equities and tips is what I would buy. If you're worried about inflation, tips guaranteed will beat inflation. If you match your duration with your time period, you get real yields of 2.1 on the 10-year, 2.6, 2.7 on the 30-year tip. So that's risk-free, risk premium above inflation. I do think equities will be an inflation hedge over the medium term, but the tips in terms of risk-adjusted excess return, it's for me a no-brainer.
Yeah, it related actually to this. There was a question, and it was put to Yanni, but I think anybody could also answer this. How are you adjusting asset allocation models in light of shifting inflation expectations and diverging central bank policies? So.
Yeah, well, this is of course something that we follow very closely all the time, and we do both strategic and tactical shifts into our allocations based on our macroeconomic scenarios, which include those factors. We are, and also touching on the previous question, we also want sort of to highlight that in this environment, this macroeconomic environment where we're going into, we do prefer equities over fixed income. We don't like to have duration in this environment, so we actually underweight duration both strategically and tactically. So we have quite high conviction there. And do think that equities, especially with the tilt on quality equities, be it not only the US, but of course globally, you will have sort of the earnings power to push through tariffs or inflation or whatever the sort of scenario is, and it is in this rates environment.
No, fair enough. Daniel, anything that you want to add on any of these topics that we just ran through, whether it's shifting thoughts on the fixed income world or currency?
Well, maybe mention on the dollar, because I don't know how many times I've seen the headline that this is the worst start for the dollar in 50 years. If you look at the real trade-weighted dollar over the last 40 years, what you see, at least since 2011, you've had 4 bouts of fairly significant dollar depreciation on a real trade-weighted basis. We're down about 5%, maybe a bit more. But previously, you had 3 instances that were more than that. And notably, one of the bigger ones was the first Trump administration. So if you looked at the time series, more or less when Trump was inaugurated the first time around, well, initially he had the dollar appreciate on the election, but after inauguration, it went into a fairly steep decline. So to be honest, we've seen this film before. You ended up having about a 9% depreciation that time. We're at about maybe 5.5, 6 now. On one hand, it's not exceptional. Now, of course, the key question is where we're going to be 1 year, 2 years from now. But I think it has been a bit over-egged in terms of the depreciation that we've had. Again, going back to that very rational reallocation of portfolios, clearly that's a key factor. I think what's going to be interesting, to go back to the fund flow argument, if, and it's a very big if, the tariffs are successful in reducing the current account deficit or the trade deficit, and then therefore that necessitates a less need for inflows to U.S. Treasuries, among other things, to finance that deficit, and then that means a weaker dollar. You can argue that that's actually a healthier situation or environment than what you had previously.
No, very good. There's a question that came in. It's related to fixed income, which we've touched on in various ways through some of you all's answers. But it was going to be the next question I was going to ask anyway, roughly. Where do you see the best relative value in fixed income right now? Sovereigns, investment grade credit, or high yield? And you could pick that blanketly, or you could pick that in a given region, or you could mix and match. Maybe it's a sovereign over here, maybe it's high yield credit over there. Andrew, do you want to jump in on this one to begin with?
Sure, happy to. One thing you didn't ask is active or passive. That would be my first answer. That I think if you're investing in fixed income and you're still doing it passively, then you're really missing a trick given where valuations are. I think I can't remember who made the point. I think Daniel probably, about capturing the volatility and taking advantage of the volatility. There's been extraordinary levels of volatility within fixed income markets year to date. Started the year with credit spreads inside historical averages in US high yield and European high yield, roughly 300 basis points on average. You're being paid for high yield credit, which is not sufficient in my mind. But by the depths of post-Liberation Day crisis, you're being paid well outside historical averages, almost 500 basis points in the US. And that felt like a great investment opportunity. And for me, the ability to recycle the credit risk that you take is really, really important if you are allocating to fixed income right now. Second thing that I'd say is, and going back to the point that was made about hedging deep out of the money for FX, I would use hedges almost everywhere. Deep out of the money, I think they're extraordinarily cheap, given what we've seen and the level of uncertainty we see within markets. You may broadly have a base case view that you prefer equities over fixed income, but for goodness sake, you ought to be buying deep out of the money hedges against your equity allocations if you are going there. My sense is that European high yield is a better, happier hunting ground from a return for risk perspective than US high yield. US high yield, everyone tells you it's in really, really good shape. It's better than it's ever been. Below the surface, there's plenty of corporates that are a little bit over-levered and a little overstretched, and I don't think you're being paid. But for me, as boring as it sounds, I'd actually be taking quite a lot of EM sovereign risk right now. I think EM sovereign risk, I think debt sustainability is really, really good out there. Debt to GDP ratio is much lower, and yet you are being paid more than you would get from European IG corporates or US IG corporates. So that's probably where I'd start from, but active.
Well, I would say before anybody else jumps in, the person who asked the question said, thank you very much for that. So apparently they agree with you. But any other comments on the where to hunt in fixed income? Anybody want to jump in on?
We're short Japanese bonds, and I think that's just crazy not to be almost. Inflation in Japan's 3.5%. It's viewed as a deflationary country and currency. But CPI in Japan right now is 3.5. The 10-year yield is 1.5. There's two potential owners who want to buy a Japanese bond at 1.5% yield, and it's the Bank of Japan, which already owns 52% of all bonds outstanding, and other people who are doing maybe short duration, short-term forwards, buying Japan, hedging it into dollar, where you get paid for something like that. But it's just an asset that gives you a return below inflation, so you're destroying purchasing power by owning it, in our opinion. So pairing that with somewhere where you're getting a real yield makes good sense, and really boring short duration corporate bonds, senior bonds from banks. You just get a risk premium there, and no central bank will let JP Morgan, BNP, UBS fail in the next 2 years on their senior paper. So it's essentially risk-free with 70 basis point pickup. So no one's going to get rich from that, but it is a nice carry with very little risk on the short duration senior side of things.
Fair enough. Anybody else?
Yeah, just to sort of a comment on our fixed income portfolio. We are a euro-based investor. That's of course very good to keep in mind nowadays. What is your home currency, because that affects a lot your allocation. But the bulk of our fixed income allocation is actually in IG, and as I mentioned, we are underweight government bonds because of the macroeconomic environment. We're expecting rates to stay at these levels or go higher, but not substantially lower. So we don't see the need to own government bonds and have high duration. We think IG serves as quite a good hedge, also considering that the duration in IG is quite long or high also. Where we tactically try to find extra sort of yield to our portfolio is within high yield. And coming back to Andrew's point here, I think it's very important sort of, is it active or passive? And we have some very good funds and managers which have been able to perform very well in this environment. There are opportunities that can be taken advantage of. And then one sub-asset class which I think is important also is emerging market debt. And here, most of our allocation is in hard currency. We have seen a lot of flows to the local currency. These are obviously coming from the US-based investors who see that sort of the currency appreciation is there, and it's been a very good investment for them. But if you're a Euro-based investor, it's still not really compelling in our view. We don't think the yield and the currency outlook is tempting at this point. However, Frontier, we think we actually allocate to, and we find it as an interesting area to be. But even in that segment, even more, it's important to go active.
Very good. Shift gears slightly. There's a couple of questions that came in. Daniel, I'm going to tap on you for this to begin with. One is, what are the one or two most notable risks that you are concerned about as you look into the second half? And the flip side of that, and a separate question that came in, but I'll pair them, is what's the most overlooked area of investment? And again, it could be equity or fixed income, classic, or it could be something unusual. Curious what you think, and then everybody else can jump in as well.
Yeah, well, the one that I'm probably still a bit the most worried about is the U.S. outlook, and particularly in terms of consumer demand. Now, if you saw, we just had U.S. retail sales, which came in pretty good, but still not great. So the framework here is, remember, if you can way back in time to early November 2024, even feels like it's decades ago. But the view that most people had at that point about the outlook for 2025, of course, was the infamous soft landing. And that was a great scenario because you were going to have lower consumer demand because excess savings was going to run out. That led to lower GDP growth because clearly GDP growth had been too high. Inflation comes down, the Fed cuts rates. And we were all going to be happy, and that was essentially your bull case for U.S. equities. Now, I'd argue if you look at the first quarter U.S. GDP data, that's more or less what you got, or at least part of it, insofar as if you look at PCE, personal consumption expenditures, in the first quarter, it was quite weak. But that kind of makes sense with his narrative of the soft landing. And again, this is only the first quarter, so argue that essentially had nothing to do with tariffs. Now, however, you add tariffs to all of this, which I think we would all agree, no matter what, is a negative shock for growth in the short term. But you're doing that on top of what was already a decelerating consumer. So you're going to get back to retail sales. So you had that weak consumer demand figure in the first quarter. U.S. retail sales averaged 0.3 over January, February, March. We just got the June data. We're averaging 0.2. So you're at a lower retail sales rate. We appreciate tariffs haven't really hit yet, and you already had decelerating consumer demand. So when things are decelerating, you never quite know how far they're going to go. And just a risk to me that it goes further than you would like. To go back to another bit of data that we got, the non-farm payrolls data really wasn't that good, even though oddly it seemed to have been presented as a positive surprise. So things are okay, but easily the possibility that it tips downward.
No, fair enough. Anybody else?
I'm at risk of being complacent on the taco trade. I think it's never the risks that bite you when you've got the same view as most. That's when it's the hardest. And I think my view that Trump moderates his views is a risk because it can spiral the other way if there's retaliatory tariffs and then it's got an escalation. A second risk I'd like to highlight is just a real crazy appointment for the next Fed chair, somebody who's just a sycophant to Trump and puts interest rates at 1%. That's something that you wouldn't expect. Most likely Waller comes in and he's a sensible dove. But if you get an unsensible dove who just is a sycophant to Trump, I think that's a risk that, not a risk for equity markets, but a risk for real significant inflation.
Yeah. Who else? Andrew, Yanni?
I would agree. So the main risks are stemming now from the US, be it either the growth outlook that Daniel was talking about, and also so the questioning of Fed independence, which Patrick alluded to here. I mean, this is not something that you expect from a country like the US. It's typically associated with the developing countries where you really have you don't have confidence in the central bank necessarily. And we saw how markets reacted to that recently when we had rumors which seemed to come and go, whether Powell will stay or not until his term is finished. So I think, and that goes to the complacency that we're seeing. I mean, cash positions are low for fund managers. Spread levels are quite tight. So that's why we are actually sticking to our slightly overweight risk strategy, but we'd probably normally be at higher levels if we didn't see this complacency that's currently in place. But we still, as mentioned, expect companies to navigate quite well in the tariff environment also.
Yeah, fair enough. Andrew?
Yeah, biggest risk that I see is that we're all in a room talking to ourselves about minutiae, and it's like it's becoming an echo chamber, and that echo chamber is populated by people who've never seen a proper sell-off, who've never seen a career-ending sell-off, and never seen a genuine crisis. And we had a go at it this year, for goodness sake. And within weeks, we're back to thinking everything's absolutely fantastic, and 0.1% on CPI actually matters. And I think that's the biggest risk, that we have a whole universe of financial commentators who've forgotten that actually things can sell off really, really aggressively. And all of a sudden, you realize that what you thought was absolutely certain is now absolutely impossible. And I think that we have a president in the White House who's able to do things that are unprecedented, because he is surrounded by people who will not point out to him that it's a bad choice. And getting rid of Jay Powell and installing somebody in Jay Powell's place who is a sycophant, as Patrick, I think it was Patrick who mentioned that, maybe we get somebody's, Yanni, that you put somebody in there, and that everyone in the US says, oh, this is fantastic, this is the best move possible. And then all of a sudden we have this massive unwind that we can't put the genie back in the bottle because the emperor isn't wearing any clothes. I think that's the biggest risk, that we are forgetting that actually bad things can happen, and we're back to assuming that it's all about the minutiae. I remind you that even at the depths of the sell-off, Tesla was worth more than almost every auto manufacturer in the world added together, even after it had sold off very aggressively. And this is a company that's barely made a profit ever, and it was still worth more than every other auto manufacturer in the world. So there is some weird stuff happening. And we've forgotten that actually sometimes there can be a really big repricing. And I think what we saw with the 15.7% drawdown was a reminder that that can happen. But goodness sake, a couple of weeks later, we've forgotten.
Well, Paul's being a catalyst, going back to the taco comment. I mean, I think, you know, among other things, we would agree with the commentary that complacency, you know, is a risk with what, Andrew, you just discussed. And second half's going to be interesting. We all talked about volatility. I think our expectation is there's more of that to come. I know we're running close on time. I do want to touch briefly on alternatives. There was a question as well as it relates to this, given a very timely topic right now going on in DC, speaking of policy change, and that's crypto. Is it becoming a real asset class, a real area of investment opportunity, or is it still something else? Anybody want to jump in on this one?
Ricky.
Yeah,
I can comment briefly about how we view that asset class. We don't invest in cryptocurrencies. It's not something that we have on the agenda right now. Actually, it's not very topical for us. But however, I mean, we do follow it very closely. It's obviously becoming more mainstream. The asset class has its up and downs. There have been sort of large fraud cases which have sort of hindered the development. I think we would have been further already in its adoption if we wouldn't have had these incidents. But you know, having said that, there are large global asset managers who are actually saying that you should allocate X% to cryptocurrencies. For us, what makes it a bit difficult is that you don't have the sort of fundamental aspect to it. You don't have the coupon, the yield, the earnings, which you can sort of attach it to. But still, having said that, I think you should still have an open mind, and we definitely do follow it very closely.
and Andrew, I think you started to jump in.
Yeah, I think you can't ignore it anymore. Our clients are talking about it. You can't ignore it. I think you have to get closer to it, understanding it. It terrifies me. Anything that's sold to me as having the best potential for upside while also being the best protection against downside. Not hugely convinced by that. And I think there is several parts of that digital asset world which are full of speculation, verging on fraud, I would suggest. But you can't ignore it. You know, we're a Swiss bank, and our clients are coming to us, and they want us to have a view on it. They want us to have a view on it because it's a meaningful part of their overall wealth net, and therefore you have to have a view. And I think the view has to be, as Yanni said, you probably should have at least a small amount in your portfolio and get used to, you know, how it behaves. Try to understand whether it is genuinely a diversifier or a risk-on asset or a risk-off asset. I think we've got to work harder at not being professional skeptics about it.
I'm going to go back to a question that I had paired with another, and all of you all understandably took the first half of the pair, but this can be a nice place to close the conversation given that we're coming up to an hour. Topic is, what's the most overlooked opportunity? All of you all talked in large part about the US. Maybe there's an element of the US market that's still overlooked. But is there something that you find intriguing? Maybe some clients are starting to ask you about, maybe they haven't yet, but you think is worth digging into that you don't think is really well discovered yet?
I have one.
Sure, go for it.
It's very old-fashioned, long short. Yeah, actually having some shorts in your portfolio while still being long, you know, broadly long, being net long. But, you know, Patrick made reference to several examples of areas where he's short. I think that, you know, mentality of being long in some areas and short in some areas, or long and then having some hedges, I think that mindset disappeared in the decade that we saw during ZERP and quantitative easing. So I think long short is something that's coming back, and I think it's really, really well suited for the environment that we face. So it's definitely something that I think having more conversations with clients.
Great comment. Other thoughts, Daniel, Yanni,
Well,
Patrick?
certainly not
Go
undiscovered.
ahead, Daniel.
Sorry, but maybe look at it at a slightly different way. So we think about Chinese equities. Remember, not so long ago, Chinese equities were uninvestable. Then you had DeepSeek, and to some degree, attitudes have changed. But at least when I talk to institutional investors, not really. I think there's still a lot of skepticism. And I think a good part of that is justified. I mean, if you look at the recent macro data that we got out of China, the GDP figures were not good. Everything's being spun that, there's no worries, but there are, which would then come to the conclusion that, yeah, you're right to be cautious about the outlook for Chinese equities. The qualifier then is, I think that's true with the exception of China tech. So I think the message from DeepSeek and everything else is that there's clearly a whole lot of talent in the country. This is something that's going to be less impacted over the medium term by tariffs, because if the U.S. puts some restrictions, eventually some very clever Chinese engineer is going to figure something out. And it's also something that can grow just based on the domestic economy. This is where the fact that there's a billion or so Chinese, that's a big advantage. And then crucially, and this is the third bit, the change in the attitude of the government. I mean, the government's no longer trying to take the industry down, it's supporting it. So if you then look at the relative performance of Chinese equities versus the rest of the world, and then just take China tech, what you'll find is you have a similar phenomenon to the Mag 7 phenomenon in the US. That is, the outperformance of Chinese equities has essentially been just China tech. So we like that bit of it, and that's something that you might want to focus on and not get too distracted by everything else around China.
No, it's good. It's interesting. Our China equity strategist and our senior China tech analyst, fellow named Rob Lee, have their China Tech 8. That's the equivalent of the US Mag 7, and would very much concur. So, Patrick, your thoughts on this one?
I'm going to steal Andrew's answer and just, you need a mandate that's flexible, where you can respond to opportunities and threats as they emerge. I think the old-fashioned strategic asset allocation, where you've got treasuries and equities, you should be thinking outside and having the ability to be flexible about derivative implementation, short positions, other asset classes. And in an environment where just tailwinds aren't always there, 2022 showed if you just buy equities and bonds, you're at risk. So the more flexible the mandate, I think the better you have a chance, at least in challenging markets.
Oh, fair enough. Yanni?
Sure, I agree with many of the previous comments, but as I mentioned previously, our highest conviction is in emerging market equities. So we do feel that the earnings outlook combined with the current valuation and the revisions support allocating more to emerging markets. But of course, sort of having worked within emerging market equities in the past, I'm very aware that it's a broad asset class, and each region has its own peculiarities. You need to take it into consideration. So again, I would advise here, this is the region where you want to go active.
Well, interesting. I would tie that back with comment about China. I was there for 5 years running our investment research business at Bloomberg Intelligence, and so I have a soft spot, I suppose you could say, and still go back every a couple times a year. And 9 months ago, the mantra was still ABC, anything but China, and it was perceived uninvestable, there as well as everywhere. And now ABC feels like all aboard China, whether it's anticipating, more stimulus, which has still been clearly slow to come, the change in Beijing policy, as Daniel had mentioned, towards technology, some of the tech developments. It's pretty interesting. So I think that's an intriguing and still very underweight area to think about. Look, we're right at the hour. I really appreciate you all's insights. This is one of the most interesting webinars that I can recall being on. So I do really thank you. I'd say to the audience, don't forget, if you got a terminal, come to BI, come to BE. We're here to help. We're the investment research business straight in the terminal. And from an Evenco perspective, those slides that I had presented on asset flows, again, that's coming from the Evenco analytics data. It's a pretty cool tool in predicting forward-looking asset flows, whether it's the product or the aggregate levels. As you can see, the error rate's been something like 2%. So pretty interesting stuff from the standpoint of, you know, thinking about where you're pushing buttons from a marketing, client presentation, client connection vantage point. So take a look and have a conversation with your Vinco folks. And with that, we'll bring the webinar to a close. Really appreciate your time and your thoughts and your participation, and look forward to the next one.